All right, so we are going to do this question, which is quite recent, 2021 question, called this Zeddemore. And when you look at what they're asking you to do, they are saying that using the capital asset pricing model, calculate Zeddemore's current cost of equity and the project cost of equity substitutable for the new venture. Then, referring to your calculations, to comment briefly on the view of the commercial director, and then discuss problems, 3 of them, that Zeddemore may face as a result of its current high level of gearing. And then also looking at both equity and debt, discuss the risk-return relationship and how it affects Zeddemore's financing costs. And some of these things are going to be a little bit similar to what we have seen before. But I've chosen this question because of the capital asset pricing model, because it's one of those that tend to show up also. As you can see in the formula sheet, we have the formula right here. So at least we shall be just figuring out how to use it, but the formula is given to us. So if we look at now the content, they are saying that Zeddemore is listed in the house construction industry. So this is the industry in which they are operating, house construction. Over the past 5 years, the results have been disappointing, and the share capital or the share price has fallen from a high of 3.5 per share, which is 5 years ago, to only 1.05 per share today. Now, this deterioration in the performance and share price has been accompanied by an increase in the financial gearing to a high level. So we have the capital structure where we have share capital and retained earnings. Then we have a long-term redeemable loan note and also a bank loan. And the loan notes are quoted at 65 per loan. And both the loan notes and the bank loan are secured. And the equity beta for Zeddemore is 2.3. So that is the information concerning the capital structure. Then they are also telling us that there's a new venture whereby in order to improve performance, Zeddemore is considering the construction of a commercial property or commercial properties actually such as office blocks, industrial complexes. So this is going to be different from what they have been doing, because they have been doing house construction. So it's a new activity, and Zeddemore was expecting that the risks involved will be different from the current activity. Directors have proposed that the project specific discount rate should be used to appraise this new venture. That's the finance director. But the commercial director does not believe this is necessary. If you remember what we saw yesterday of using the cost of capital, if you are to use it, it means that 2 things have happened. The gearing of the company is not going to be changed by the new investment, and the risk of the business is not going to be changed by the risk that is coming with the new project. So now that's what you're going to have to discuss on this part. We have another company called Winston Commercial Properties, which does commercial construction projects like those that we are considering. They have an equity beta of 1.25, and then WCP has 100 million of ordinary shares in issue, which are at 2.6 per share. The shares are $1 nominal. And the company also has 110 meters of loan notes in issue, which are right now at 96. And both of them pay tax at 20%, risk-free rate is 4%, and the expected return on the market portfolio is 10%. Now, remember yesterday when we saw a computation of cost of equity for a company where we used the dividend growth model, we said that there are a couple of methods that you can use, and you choose them based on what information is given to you. Now, anytime you are doing a question and you see the risk-free rate and the expected return on the market or the risk premium. And those three things, usually you don't get three, you get two. You always get the risk-free rate, and then you can either be given the risk premium or the market return. When you see those things, you think of capital asset pricing model. And of course, we are going to show you how that is used. So let us, in fact, go and take the formula. So this is the capital asset pricing model. Now, this capital asset pricing model, when you look at it, it says that the expected return, which is usually the cost of equity, is given as the risk-free rate plus beta, and this beta is usually equity beta. And I'll try to tell you the difference between asset beta and equity beta, but that's the equity beta multiplied by the risk premium, which is given by the market return minus the risk-free rate. So in some questions, they give you the risk premium, whereby they have given you this whole thing, or they will give you the market return, where you have to subtract the risk-free rate to get the risk premium. So don't make a mistake of subtracting when you have the risk premium already, because then you would be getting it wrong. Okay, so which means that for us to work this out, we need to know the risk-free rate. Then we need to know the beta equity. Then we need to know the risk premium, or at least the market return. So in this case, in this question, they gave us that the equity beta is 2.3. So we can put that 2.3. Risk-free rate, they've told us it is 4%. And the market return is 10%. Therefore, we can get KE. And it's given as the risk-free rate plus beta multiplied by the risk premium, which is the market return minus the risk-free rate, which gives us something about 17.8%. So that is the first question. They asked us to calculate the equity beta using the capital asset pricing model. You can see 6 marks easily got like that. You just have to know how to use the formula and what items you need. Okay. Any questions on that part?
No.
Okay. Then they're saying that referring to the calculations that we have done above, comment on the view of the commercial director. So the commercial director, this is his view. He's saying, because the finance director is saying that we should use a project specific discount rate on the new venture, whereas the commercial director does not believe this is necessary. Now, let us see. So if you look at what it would mean, because here they are telling us to just we haven't finished some part of this. They wanted us to calculate using capital asset pricing model, the current cost of equity But then they also want a project-specific cost of equity for the new venture. Okay, so we need to first do that before we can come and discuss this, because we have to have both of them. Then we can now say whether the commercial director was okay to say that or not. Okay, now to get the project-specific cost of capital for the new venture. Now, what normally happens is, if you do have a project that is different from the company's operations, you can't use the cost of capital that you have calculated. Okay, you can't use this KE that I've put here. And in fact, you can't use the cost of capital, which even has the KD in it, because cost of capital, as we saw yesterday, has both equity and debt. So now, but if the company's risk is going to be changed by the new venture, which is always going to be the case if the company is going to be doing something which is new for them that they haven't done before or they have not been doing, then chances are you can't not just pick a value and use. So you have to actually get one. And how do you get it? So first of all, the steps are: get a proxy company. And here we mean a company doing the activity you are trying to do. Okay? That's why we have this company here given to us, Winston. Because Winston is doing commercial construction projects similar to those that we are trying to do. So here, what we are doing is a project-specific cost of capital. Okay, so you need to get a proxy company. And why would you get a proxy company? We need to get its asset beta. Now, so now that brings us to the asset beta and equity beta. So the equity beta, so first of all, beta in this case represents how risky the project is relative to the market. But equity beta represents how risky a project is relative to the market, but incorporating both business risk, okay, which is the fact that you are doing a new project that probably haven't been doing, but also gearing. So as equity beta also incorporates gearing, whereas this one, it just only looks at business risk. So asset beta only looks at business risk, whereas equity beta looks at both business risk and gearing. So what that means is that when you have a company, which is this proxy company that you have got, Winston may not be having the same gearing as you do. Like they may have 20% debt, whereas for you have 70% debt. So it means that that part we saw yesterday of the gearing not changing won't be correct. So you'd have to adjust for that. So how do you adjust for that? You go to a company. This company normally is a listed company, so you can even easily get its beta. Okay, when you go to Yahoo Finance, you can search for different companies' betas. You'll be able to see them, those that are listed. So you can easily get its beta. Now, that beta, what you get on that website is always equity beta. Okay, so perhaps I should say gets its equity beta. Then step 3 is de-gear the proxy's equity beta to get the asset beta. So when you go and get the equity beta of this company, because it has both market risk, I mean both business risk, but also gearing, you de-gear it. So you remove the effect of the gearing and you only remain with the effect of the business risk, whereby you get the asset beta. And now step 4 is you re-gear the asset beta with the project's gearing, okay, or debt to equity. So Winston has a different debt to equity, but we want to use the one of this company, Zeddemore. So we remove the debt to equity ratio of Winston from the equity beta which is given, and then we can now come and put the one that is Zeddemore's so that we can be able to get the project specific cost of equity. And from there, step 5 is use capital asset pricing model to get cost of equity. And then, of course, if you have the cost of debt, use cost of debt, cost of equity, market value of equity, market value of debt to get project work. So those are the steps that you go through to get the project specific cost of capital. And let us go through them. So, proxy company, we have it already, Winston. So, how do we get its equity beta? We find out whether they have given it to us, or we go to the in the real world, you would go to the finance portal and you get it. So equity beta is 1.25. So B equal 1.25. So that is step 2. Now step 3, the gearing. Now there is a formula on the formula sheet which helps us to calculate the asset beta formula, and it's given here. Looks like a big formula, but I'm going to make it smaller. So now this asset beta formula is the one we are going to use, but it uses the market value of equity, market value of debt, the tax rate, and the equity beta, and also the debt beta. Although debt beta is usually assumed to be 0, and therefore this whole part dies out. So you end up with only this part here. Okay, this is the part that you end up using only. So it means that for us to use it, we need to get value of equity, value of debt, and then the tax. So let us get those items. So value of equity, value of debt, then tax. So value of equity. So Winston has 100. Okay, these are not. This is debt. Let's first do equity. It has $100 million of ordinary shares. Okay, which is $1 nominal, which means that these are the same number of shares we have, 100 million, because normally divide by the nominal value to get how many shares you have. And then you currently quote at 2.6. So you can easily get market value of equity by saying 100 million divided by 1 to get the shares multiplied by 2.6. So that is the value of equity. So that is 260 million. Then for the value of debt, it has also 110 million of loan notes, which are quoted at 96 per 100. So 110 million divided by 100 multiplied by 96. That gives us 105.6 million. Then the tax, they told us 20%. So then we can find the asset beta. So asset beta, as we said, is going to be value of equity divided by value of equity plus value of debt multiplied by 1 minus the tax. Okay. Multiplied by equity beta. So that gives us 0.94. So that is now the asset beta. So we have gone to step 3 now. We have finished step 3. Now step 4 means year. So I can put here Winston, so that you know that this is for Winston. So then I can now put here for Zeddemore. Now for Zeddemore, we are going to now get this asset beta, the one we have got from up. And now we need to find the value of equity, value of debt, tax, but now get the equity beta. So let us get that. So value of equity for Zeddemore, we know that we have 40 million, 0.5 per share nominal value. And also where's the share price? The share price is now at 1.05.
Market value is 65.
Yeah?
Market value is 65. Oh, loan notes. It's
That's
okay.
all on notes. It's 1.05. So we shall get 40 million divided by 0.5 multiplied by 1.05. So that is 84 million. Then for debt, we have redeemable notes and a bank loan. So now, for the bank loan, like we said yesterday, usually that's this market value, 20 million. But for the loan notes, because they're redeemable, we just use the formula we saw yesterday of growth. But because we don't have growth, this part go, and we just divide the dividend, or in this case the interest, because this one works for both interest and dividend. So we shall use here interest divided by the market, divided by the, oh, are we getting value of debt? Oh, so no, we are getting value of debt. So for value of debt, we are using this one. So we are getting the interest. Let's first see what we have. We have oh, no, we do have the market value 65. So we just do 250 million divided by 100 multiplied by 65. So which gives us 162 million. Tax is the same, 20%. Now to get the equity beta, we use the same formula, but we only arrange it such that all of this goes on top and this one goes at the bottom. And I'm sure I'm not explaining it so much here because this is just arranging the formula, making BE the subject, which I am thinking that we are all very good at. Okay, so So it shall be value of equity plus value of debt multiplied by 1 minus tax divided by value of equity times the asset beta. Somebody seems to want to ask a question.
Yes.
Yes.
Herbert, did you include the value of the bank loan to the VD?
Yes, yes. Let me include it.
Okay.
20 million. Okay. So we just add it to the other value that we have computed. So that is 20 million. So which gives us a value of 2.58. Okay. And now we can now use CAPAM. Risk-free rate, we already have it. Plus the beta equity multiplied by the difference between the market return and risk-free rate, which gives us this is KE now. Okay. Okay. So which is about 19.5%. Okay. So now, if you can check, the one we got up was 17. The one we get up is 19. So the project specific cost of equity. Now, one thing we haven't done, okay, and let me confirm that we didn't need to do it. Yes, the question said project specific cost of equity. Now, because we are looking at cost of equity, we don't have to do work. Okay, that's why I didn't do these steps here. We have stopped on step 5. Okay, we haven't done step 6. Because for step 6, you would have to get the cost of debt. Okay, and then you calculate work. But the question asked us to stop at cost of equity. So I hope that is clear. So we are saying that project specific cost of equity is higher than the company cost of equity. Okay, and thus the commercial directors comment that it doesn't matter is flawed. Okay, and what does that mean if it's flawed? If used, because remember it is lower, right? So if used, the project may be wrongly accepted, yet it will lead to a negative NPV for the company. Okay, so that is the comment that we are making here. Is it clear?
Yes, it is.
Okay. So now the second part is that we are saying what are the 3 problems that we may be facing because of the high level of gearing. So of course we know that gearing means debt to equity. So high level of gearing means we have a higher proportion of debt. And what does that mean? Liquidity problems. Since interest has to be paid regardless of profitability. So when you have a debt, you have to pay interest every year or every month without fail. Even if you have not made profits, even if you have cash flow problems, they will still want you to be able to pay, okay? To pay the interest. So it means that it will cause you to have liquidity problems, but also it can increase cost of financing or cost of capital. Okay, as it increases, the risk of the company and shareholders may require more return for the increased risk. Okay, shareholders usually give you money, but they want you to give them more return if you have more risk. So, and this is not the only way it increases it, because even when you have high gearing, also banks don't give you cheaply the money if they give it to you, which also comes to debt capacity. Reduces as banks are not willing to lend you money or more money, or are willing to do it at a higher cost of debt. Okay, so they asked for 3, but also there are things like bankruptcy, which can come from liquidity, right? Which can arise from liquidity. You know, bankruptcy is a legal term whereby you file that you are unable to pay your creditors. When that happens, then they can put your company into administration, or they may dissolve it. So these are some of the things that could happen to you if you have high gearing. And then the third question is asking us the relationship between risk and return. And I've hinted some of it. So risk-return relationship. Okay. So now, here, what you are trying to answer is, what is the relationship between risk and return? Or rather, how is it that when you go and want to raise equity finance or debt finance, different people want different returns? What's the relationship there? So, first of all, the thing that you need to know is that debt is considered cheaper than equity. Okay? And why is that the case? Because debt is less risky than equity. And there are different reasons why that's the case. For example, because interest has to be paid regardless of profitability, whereas dividends are paid only when declared. So with equity, You can tell your shareholders that, okay, I'm not going to give you I'm not going to give you dividends this year, probably because I'm trying to invest my money. Okay, you could tell them that, and they could understand it and not give you trouble. Whereas for equity, I mean for debt, the debt holders get their interest regardless of your standing. So that makes debt cheaper. The other thing about why debt is cheaper is that interest payments are, are deductible for tax purposes, which means that the cost of debt is actually less than what the debt holders are taking as interest, because you reduce it by 30%, by 20%, the tax element. So those are the reasons why uh, that that makes it cheaper for it to have debt. So I've put the other. Let me try to write all those things that I've said so that you get the idea. So debt is cheaper because it's less risky, but you can also say equity holders carry more risk because they are not guaranteed a return. Okay, the debt interest has to be paid first, and any earnings left could be paid to the equity holders if declared. So you can see why equity holders will not want you to have so much debt. That's why they don't like having so much gearing, because they hire the gearing, then in the case of payments, they are the last one to be paid. Another thing is that on liquidation, equity holders are paid last after clearing all creditors. So these are several reasons why actually equity is more expensive compared to the debt. So, of course, you may look at this question, and this we have discussed the risk-return relationship, but now we are going to try to see how it affects Zeddemore's financing costs. Okay, so now ideally here, all you are going to do is to bring it home by putting Zeddemore in the statements. So you'll be saying, since Zeddemore has a higher gearing than industry average, if that is what has been said, okay, it means that the cost of financing will increase because the shareholders will deem it more risky for the reasons we have said above and require more return. Another thing you can say also, the banks would charge them more interest or higher interest rates if they opted to get debt financing. Okay, ultimately the cost of capital for Zeddemore will increase, meaning it will have limited investment opportunities that can have a positive net present value. And get yourself your 6 marks. Okay, so I mean, if you want to see how this has been polished and written, you can check the solution, but right after trying to do this question yourself. Is there any questions before I proceed?
Yes, I have one question.
Okay. Hmm.
Is the equity beta for the proxy company always given?
Yeah, if they want you to use capital surplusing model and you are trying to appraise an investment which is specific, yes. If they don't have that information given to you, then probably that's not what you are supposed to use. There is a trick that you need to learn. You need to read the question and list down what you have, and then come up with what you expect that the formula should be what you are going to use. It comes with practice. So, yeah, but yes, in this situation, they'll give it to you if that's what they want you to do.
Okay.
Yes. They can even help you further and give you its asset beta. If they do the asset beta, that means that they have saved you from having to actually de-gear. Okay, this part here, step 3, would have been solved for you, and they give you the asset beta. When they say equity beta, you have to do the step. Okay, so let me see. Let's skip that one. Most of these are the same. So okay, most of these are the same. Let's just do one more. Let's do Tanza. So, and when I say they are the same, it means you can save time. If you have understood the way this go, you just go through these questions and see only what has changed. Okay, so that you make sure, especially for the theory parts, this second part that usually come here discussing those things, you usually those will be different, and then the computation is the same for some questions. So you make sure that you, as you are reading towards your exam, you finalize by looking for those section theory parts and writing them down for revision purposes, and then you see what changes for each question. Because ideally, you're supposed to do the entire kit to feel certain confidence that you are able to do the exam, but sometimes it may not be possible. So you try to close the gap by looking for now what is new. So this question here, Tanza, uh, it is asking for the after-tax weighted average cost of capital. Okay, so similar to what we saw yesterday. And then they want you to discuss the difference to the relevant theory, the views of Director A and Director B on raising new finance. So here we shall have to talk about the relevant theory. You need to know it. If you don't know it, then you may not get all the marks for this part. You can still get it, but not all of it. And then also discuss two other factors. Yeah. Discuss two other factors to consider when you are trying to raise debt finance or equity finance. Okay. So if you look at what is given to us, they are saying that Tanza has the following sources of finance. So we do have the ordinary shares, convertible loan notes, and the bank loan. And then the ordinary shares are trading at 5.55 per share, nominal value 0.5. Ordinary dividend of 0.85 per share has recently been paid. The director has indicated that dividend of 0.9 will be paid on 31st December 2007. And the dividends and share price have grown steadily at 6% per year for several years, and they are continuing to do so. So here they have given you two values for dividend. The one which has just been paid and the one which will be paid next year. Okay, so you need to figure out which one to use. In most cases, it is okay, we shall get there, but it's the one that has just been paid, okay, which is the D note. Although there is a situation where you can use D1, okay, but okay, we shall see. Then for the loan notes, each loan note has a nominal value of $100, trading at 108. On 31st December 2009, the investors holding the convertible loan notes may convert. So these are how many years? I think these are 3 years. They can convert. So this is now convertible. Okay. Yesterday we saw the theory. Today we are going to deal with the convertible loan notes in calculation. So they can convert them into 20 ordinary shares. But if they don't convert, then they will redeem at a nominal value, and the tax is 15%. Okay. Then Tanza needs to raise a further 200 million of long-term finance, and the directors have been discussing whether to raise through borrowing or issue new share capital. And they want this finance very quickly. This is also important. They want it very quickly. So during the discussion, we have directors. Director A said we use debt, and she heard that a high level of gearing of the company can make cost savings, which improve the weighted average cost of capital. This is one theory. And then we have Director B, who says that Tanza's capital gearing is amongst the lowest in the industry. So competitors have higher gearing than we do, and also have lower weighted average cost of capital than us. Although I don't think when gearing gets high, work gets up again. We shall break down this theory. But this is the second theory. So we are going to discuss these theories. And so let us first start by calculating the work. So like we said yesterday, when you are trying to get work, you look at what are your sources of financing. So we have ordinary shares. So this is Tanza. So we are doing work. So we have ordinary shares. We have convertible loan notes. Then we have the bank loan. So we said yesterday that you can get the cost of capital, then market value. And then you multiply market value by the cost, and then you get your work. So let us first look at the cost of capital for ordinary shares. So now, as we said, look at what is given to you. Because here they could give you information that can be used for calculating using the so-called capital set pricing model. Or they can give you one where you are going to use the growth model, this one right here, which we used yesterday. And it seems that's what we have to use today as well. Now, so for this, let us work out the cost of equity. So we are going to use this formula. So we will need D naught, we will need G, and P naught. Now, they gave us two Ds. They gave us 0.85, which is D naught. Then they gave us G, which is 6%. Then the share price is 5.5. And you need to know whether this is before or after dividend, but the dividend has just been paid. So this is ex-div 5.55. Now, I wanted to tell you that D naught and D1 have a relationship. If you get D naught and multiply it by 1 plus the growth, you get D1. Okay? 0.90. So you can use this formula here. This part here above is D1. Okay? When you have D1. But when you don't have D1, it is D naught 1 plus G. The same thing. So here we are going to use D naught multiplied by 1 plus G divided by the cost, the market value, then plus G. So that gives us about 22.2%. That's what goes there. Okay. Market value, that one we can work out because we have 50 million and it's 0.5. So multiply by the 5.55. So that gives us 555 million. Then for the convertible loan notes. Now, convertible loan notes, so what we saw yesterday for loan notes is that you set up years, year 0, that's the market value, which is 108.51. Then this is the cash flow here. Then, so remember this is in 2006, December. So 7, 8, 9. So those are 3 years. So that means from year 1 to 3, there will be interest, which is 6%. So that is $6. But we need to know the tax rate, 15%. So this will be 6 multiplied by 1 minus 15%. So it becomes 5.1. Then now year 3. Now year 3 is where we have to decide whether to redeem or to convert. So I need to first of all determine. So on year 3, we either get cash, which is $100 nominal, because they said if we are to get the money, we get nominal value, or shares. That is 20 shares. Okay? Now, those 20 shares, what will be the share price in 3 years' time, right? So right now the share price, they're saying that both the dividend and the share price have been growing at 6%. So we are going to get the share price of 5.55, but we grow it, okay, by 6%, but for 3 years. So that is 132. So if you are to choose between these two, you choose the higher, right? That's how you choose. So we have conversion here. Or we don't have to write the conversion, but we can write the 132. That's what we shall convert to. So now we have our cash flows. As we said yesterday, we can start from 10% discount factor at 10%. So this is 1 here. This is an annuity. 1 minus 1 plus 10% per minus 3 divided by 10%. Okay, this is a formula that you don't have to cram. It is right here for an annuity. Then this one is normal, 1 plus 10% per minus 3. So then you can get present value at 10%. So that gives us 3.49, which is positive. So that means that the next one is going to be something at like 15%. Sometimes you can see that you are close to getting 0. Then you can just put 11% here and hope that works, but better to just do 15%. So 15%, we are just going to copy these and convert and change this to 15%. Then you have present value at 15%. Okay, which gives us a negative. Now for IRR, we saw yesterday the formula. I can just bring it back in case you forgot about it. And I think this is not that we used yesterday. Okay, no worry. It's going to be given as the lower rate, which is 10%, plus NPV at the lower rate divided by NPV at the lower rate minus NPV at the higher rate multiplied by the difference between the higher rate and the lower rate, which gives us 11.3%. Okay, so we can have the convertible loan notes at 11.3%. Then market value, that one we notice 150 million divided by 100 times 108.51. 108.5. Which becomes 162 million. Okay. And now the bank loan, what we said yesterday, for this one, the market value is basically what you have. The only thing that we can do, so now, yesterday, the bank loan was at a variable interest rate, so we didn't have its interest rate. But now we know it's 4%. So for the cost of capital for the bank loan, it will be 4%, but after tax. So you subtract the tax, which is 15%. Okay, so this is another way. As I said yesterday, you can be given the interest rate for the bank loan. You just do after tax. If you are given variable, then you can assume that it's the same as the one for convertible loan note or for the loan notes. Or you can be given a question where you have to amortize. And so this is the interest. And the market value for the bank loan is still going to be up to 120 million. Okay. So then you can just sum the market values up. Then you can also multiply the cost by the market values. Sum those ones up. Then you can get the work by dividing this by that. So the work is about 17.4%. So that is part one done. Okay, I don't know if you have any questions before we just go to the second part. No, I hope not. Okay. Now, let's now go to these views. Okay. These views, the first view is for Director A, says we should use debt because she heard that at high levels of gearing, company can make cost savings which improve the weighted average cost of capital. Now this one is called the Modigliani and the Miller's theory. I don't know if you guys have seen this in your travels. Have you seen it? Do you know about it?
Yeah.
Okay.
Yeah.
Yes. And that theory, so Director A, Director A is considering the Modigliani and the Miller theory, but with the tax, because there are two theories, one without tax and one with tax. The one without tax says it does not matter what gearing you have, because the cost of capital kind of balances itself out and it stays the same. But the one with tax says that whenever you increase gearing, your work reduces. And the reason why it says that is that with high gearing, there is more savings from the tax reductions, deductible interest payments, also from the cheaper debt compared to equity. Okay, I'm not trying to be so detailed again about this, because as we saw in the previous question, we said that equity is more expensive than debt. So when you use more gearing, that means when you get more debt, means you are getting cheaper financing. So there is that. But also, when you pay interest, they give you tax deductions in most countries, including Uganda here. So which means that you end up incurring even less because of that. So that is what Director A is saying. And therefore, she suggests more debt. Okay, suggests more debt. And of course, we are going to say some, however, part, but let us first see what the Director B is saying. Director B is saying that we have very low gearing. Okay? And our computers have higher gearing than we do, but also have lower weighted average cost of capital than us. But they don't know, or they don't think that gearing gets high, the work goes up. Now, that theory that they are looking at is the traditional way of looking at gearing. The traditional way of looking at gearing and cost of capital goes like this. It says it has, of course, when you're starting from, because this is gearing here. Sorry, I can't write. I don't have it. I don't have a touch machine, so can't write. But they have gearing here on the horizontal, and then here we have the cost or the work. They have different items in there. Of course, the cost of equity always increases. So when you're looking at cost of equity, it increases with debt. Because as we said, risk and all that. And then the cost of debt, it decreases, but at some point it starts increasing again. Okay, so ideally, when you are still at a lower debt, you are able to get cheaper financing. But as you increase the debt, you get cheaper and cheaper. But a point reaches, okay, where we call the optimum point, where you have the lowest cost of capital. But after that, when you increase gearing some more, it starts to pick up again the cost of capital. And the reason why that becomes the case is that, okay, now banks start thinking, okay, your risk has increased substantially compared to what it was before. So they either are going to give you less money or they give you money but at higher interest. Okay, because the gearing has increased the risk. So it starts rising up. Okay, so that is the traditional way of looking at gearing and weighted average cost of capital. So that's what Director B is saying. Now, because we have the lowest level of gearing, because we are still this side, okay, Director B would suggest that we should start borrowing. We borrow and borrow using debt as we monitor the cost of capital to decrease. But as soon as we see it start to increase, then we have to maintain at that level, the optimum level, such that we do not increase our gearing beyond that point because the cost of capital will start to increase. So those are the two views that these directors are having. Okay, if you want to really learn more about them in case you don't know, you can, as I said, go to the textbook, or for this case, if you go to the solution, you would find that they have mentioned these different views. So we can actually look at here, Mogdiriani and Mira. Yes. Okay, these are Mogdiriani and Mira. You can read about them here and understand basically what they say, but these are what I've given you, and also what you can find the solution can help you understand these two different theories and what it means for the different directors, what they are saying about what should be done. Because they said critically, with the reference to the relevant theory, the views of directors A and B on raising new finance. Now the third party is saying two other factors that they should consider. So factors that we can consider, the first thing, what I showed you when you are reading, is that they wanted it quickly. So when they want it quickly, it is far much easier to raise debt quickly than you can raise equity. Okay, other factors. Because they said quickly, debt is quicker to raise than equity. With equity, you have to get a broker, like we said. That broker would have you have to have you register the shares that you are going to allot out. Then the broker starts looking for people who are going to, they advertise basically, public offer and all that. Whereas with debt, you just go to the bank, get money. Even if you are going to sell, if you're going to sell like bonds and bills, still it is much easier for you to do so than to raise equity finance. So that is very important. Then the other thing is that if you have security. So security in this case refers to things like that you can give to the bank to secure your borrowing. That can make the cost of debt cheaper. So what this means is that if you have already been borrowing, of course, they say that you have lower gearing, so we haven't borrowed so much, so probably we still have some assets that we can offer up for security. So that means that we do that, we are able to get cheaper debt. But if we didn't have them, then debt will be more expensive. But another thing that you can consider is, when you're going to issue, because remember, we don't want to consider the factors that have been looked at above regarding gearing. Okay, so we are looking at, if we have a company, so let's say the effect of the financing on the dividends of the shareholders. Okay, so here what we are saying is, now the shareholders that we have been getting dividends, right? They've been getting dividends. So if you were to give them less dividend because you took on more debt, then they may not be happy with you. So you need to know what the effect is going to be on them once you take out more debt and reduce on your interest cover. Not interest cover, but dividend yield. Okay? Because they will not be happy if you give them less dividend than you did before. So these are some of the other factors that you should consider. All right, so they wanted you to discuss two. These are the two strong ones that you can give. But you can even discuss this in case you didn't know one of the two. So I don't know if you have any questions from this question that you have just attempted. No?
Not any.
Okay. All right. So I think now these are sufficient questions that you can use to accompany the others that are being attempted on the platform. What I advise you, like I said, go to each of the questions that are under this section and read through them and see what has changed from the ones that we have done so that you can see how to deal with them. Now, like here, we have seen convertible loan notes and how to deal with them, which is different from yesterday. Like if you hadn't seen this question, probably you do not know how to deal with them. You know how to do everything but that part. But also when you find yourself in that situation and you don't know how to do with one part, but it's the only part, you can just assume you didn't see the issue of convertible loan notes and you proceed like the normal way and miss a few marks, but continue with the question. Okay, so I think that's it for today and for this week. Thank you very much, and then see you next week.
Excuse me, Herbert.
Yeah,
What are we going to cover next week?
next week.
Mm.
Okay, so we can what I'm thinking, because we have done the two big sections. So probably you guys can let me know which of these sections needs more like ironing out for next week. What I was going to do was to kind of pick another question or two from investment appraisal, given that it's one of those things that you really need to know how to deal with. Okay. Any section that is more difficult for you that we can focus on more?
It was investment appraisal for me.
Okay.
And working
I think,
capital.
I think, yeah, investment appraisal. These all buy that thing.
Okay. Okay. What about you, Rina?
Working capital.
Yeah?
Working capital.
Working capital. Okay. Okay. So since we do have, I think, uh two I think 2 more weeks. So we shall do investment appraisal next week and then do other working capital questions from the other week. Sounds good?
Yes.
All
Yeah.
right. Okay. So see
Okay.
you next week.
See
See
you.
you.
Thank you.